Hey everyone, welcome to the Tech Enabled Agent Creative Real Estate Podcast. My name is Hunter. I'm excited to have a good friend of mine, Mark, on to talk a little bit about his background and what he is doing in the real estate space. So, Mark, how's it going?
Good, man. Seems like we just met in person for the first time a few weeks ago, man.
I know. Yeah, good to be able to meet in person, face to face, and the whole virtual reality, social media stuff is great, but when you can get in person, it's always the best.
It was a lot of fun. Thanks for having me on, man.
Absolutely. So I know your name is the financial firefighter, and I'm sure we'll get into that. But Mark, tell me a little bit about your journey in real estate. What drew you to it? How did you get started?
So my journey started more from, I guess, I don't know how much you want me to talk about it, but I was definitely headed down the W-2 path. Had a pension. I'm in the fire department, so that's kind of where the name comes from a little bit. So, 17 years or almost 18 years in the fire service already. So, yeah, I was definitely headed down that path of just, that golden handcuffs, the pension, all my benefits and something changed, 2020, the world kind of changed, a lot of things happened, and it made me started really looking at how, kind of relying on this pension was very risky. At some point, it made me realize how at any point they could kind of tell you what to do, and you have bills to pay, and whether you agree or disagree, sometimes you got to go along with it so that you can pay these bills. And that made me look at income streams, and that's kind of what put me down this path of trying to look for different ways to generate income. I guess the popular phrase back then was passive income, right? And we can kind of dig into that, how it's not too passive, a lot of things, but just generating multiple streams of income. And that kind of put me where real estate, other people might go to stocks or crypto or whatnot. But
Mhm.
for me, especially being in Hawaii, real estate is very um, popular, I guess, from a net worth standpoint. So real estate always felt like the safest path for me, and that's kind of why I went into to real estate. But it also made me invest out of state after looking at the numbers in Hawaii, and I do invest in Pittsburgh. So yeah, that's the kind of a quick summary of that.
Yeah. No, that it's funny that you mentioned the passive income, right? Because I think that's what has really been preached for the better part of 10, 15 years since, coming out of the '08 crash. It seems like bigger pockets and everybody was all about, hey, raise money, go buy three houses and you can quit your job because passive income. And, I wish that could be said for me, but I think myself, similar to you, and I'm sure many others, that was not their story. It's not just you buy two properties and you're making, 200,000 a year in cash flow. It's just, sure it happens for somebody, but
It does happen for some, but I think, like you said, a lot of us that are doing it, you kind of realize and kind of see where that whole passive income is just a little blown out of proportion, I guess. It is it always is some work involved, but you do sometimes the goal is to get the least amount of work you have to do for it, but there's always some sort of work involved in it.
mhm. Yeah, absolutely. Mark, how did you end up in Hawaii?
So I'm born and raised out here, so I think that's, part of the I say problem. A lot of people look at me when I say that. They think I'm crazy a lot of times when I feel like or when I say that I enjoy being, like in North Carolina, South Carolina, where you're at, that Tennessee area. But I was born and raised out here, so it's a great place to live. It's beautiful, great weather. But as a lot of people probably know it's very expensive. You have high taxes. We don't have a lot of the jobs as other areas might have. So, a lot of people are, living paycheck to paycheck, or, and I talked about it on one of my episodes recently, is I think people uh, get caught up in the fact that you're living in paradise, so it's okay to be living paycheck to paycheck. So it's kind of a trade-off. And I think, what you're trying to do and what I'm trying to do is we're trying to help people realize that, there's some work involved, but you can live in these high or expensive areas, but you just got to put that little work in for a while and have a change your mindset. And where real estate comes into play and whatnot, and just looking at asset classes and cash flow differently and how money works. I think that's the biggest thing.
Yeah, no, it's all about picking the right assets and right location. I mean, if you're going to buy a single family house, I know what the average price point is for you, but I'm it's probably close to 1 million, if not above 1 million.
Yeah, yeah, it's about $1 million, medium family, single home. We do, what I don't know if it I would tricks people, but a lot of people, maybe when they look for homes out here, they see like condos and things like that, and they see, oh, it's not too bad. You might find like a condo for, 500,000, 600,000, but you don't realize like the HOA fees for a lot of these places are almost as much as the mortgage for certain markets, smaller markets in the mainland. So you could find this $500,000 condo, but your HOA for the might be like 1,500, 1,600 for the month. And you don't really realize, it's kind of hidden in the description in some ways. And you don't realize that. You just see the sales, and then oh, it's not too bad in Hawaii. But then when you start digging deeper, you realize that there's these other costs, and just even cost of living here is very high. So, for me, I think a lot of people, like my parents' generation, it was, you get a home, you live in it for 30, 40 years, and now you're a millionaire. Your net is over $1 million, and you're supposed to be well off in a sense, right? But I think you would agree that a lot of times net worth is a little bit overrated in some ways. It's a great view of what your worth is, but at the same time, you need income coming in to pay your bills and live. And I think a lot of people in Hawaii are finding that out is they may have this $1 million paid off home, but their property taxes haven't gone away. They have insurance they still have to pay. I mean, as we know, inflation has probably been like over 20% for the past, 4 or 5 years. And, gas prices are high. So you have all these expenses going up. And even though you have this $1 million net worth, you still have bills to pay and you need that cash flow coming in. So I think it's just changing people's mindset of looking at how money works. And I think that's what we're both trying to do.
Yeah, cash flow is king. It certainly is. And I don't, this was a Coach Carson quote, or maybe I heard it somewhere else, but they were saying that you can't eat your net worth, but you can eat or eat off of your cash flow, so it's all about all the passive income as you were initially going for.
Absolutely. Yeah, I totally agree.
Well, Mark, how did you get into your first property? Being in Hawaii, trying to figure out what, makes sense investment wise. What was your first investment? How did you come about finding it?
So that's kind of a question, like I said, I kind of touched on it a little bit, is where I never really, I would say, considered myself an investor up until maybe 2019. I didn't look at it that way. I just looked at it as I'm buying, whether, I had a condo back in 2006, I believe, is one my first property. But I didn't look at it like I was going to be a landlord. I didn't look at it from an investment standpoint. It was more, I need a place to live. This is where I'm going to live. And supposedly, if I do this for 30, 40 years, then I'll be a millionaire. And that was kind of the game plan. So I got a condo, and it was more looked at as just this place to live, a primary residence. And then I did transition into a single family home, 2015. And same thing though, the blueprint more just looking at it where, okay, I have this property, sit on it for 30, 40 years, and I should be fine. And that was always the game plan. And then things kind of, like I said, back in when the world kind of changed, I started looking at things differently. And that's where one of my friends was investing in Pittsburgh. So he's in Hawaii also, but he was investing remotely in Pittsburgh, Pennsylvania. And he was always talking to me about, yeah, you should look into this. There's these homes for like, 75K, 100K, but they cash flow this much or the rent is this much. And I was just like, no way. Like, in Hawaii, you just, like I said, you see only these $500,000 homes, $1 million homes. And I never, there were these places or pockets or these markets where, homes, median family homes are like 200,000 or whatnot, right? So once I started looking into it, I was just like, man, this is easy. Like you just buy this property for 100,000, it rents for 1,500 and you're making money. So I looked at it as like this ticket out. Like this is the way to do it. And that kind of flipped my whole mindset on buying properties in Hawaii or as how can I leverage what I have in Hawaii to get properties in Pittsburgh? And so fortunately, I still had that condo that I bought in 2006. So there was some built-in equity. And so that's kind of how I started initially buying properties in Pittsburgh, was using HELOCs or line of credit. And that's how I got started. So yeah.
Yeah, no, that's a way to get started. I know many investors who have done the same. It's, utilizing, that nest egg that you've already built and saying, hey, my return on my equity is very low. You might be getting some appreciation, but there's no cash flow out of your primary residence. So figuring out how can you capitalize on that. So that's a great strategy, as far as being able
Well,
to
so
purchase.
touching that a little bit too, though, is like I said, the whole mindset thing and like parents' generation, it was always about paying down your home. So that's also why there was this equity built up in this condo, was that I don't know if people talk about it too much anymore right now because of the HELOC rates being higher and whatnot, but like velocity banking. So people, you get a HELOC, which the interest rate is simple interest, is not amortized like a mortgage, and people are just focusing payments on their principal, their of their debt on their property. And so I was focused on paying off this condo. So that was my focus. Like as we might, learn more, is like that money could be better utilized somewhere else to be more assets. So that's kind of also why there was this kind of equity built up, like you're talking about, and it allowed me to kind of focus on Pittsburgh and acquire properties that way.
Yeah. So let's touch on velocity for a second because I've looked at them myself, but I haven't used them, and I know there's some people that have probably never heard of it. Can you tell me a little bit more about what it is and what they offer?
So yeah, velocity banking, and there's different names for it. People use sweep strategy. There's some other names out there, but basically it's looking to a lot of places. Like so, Hawaii's like was a perfect area to do it, because at the time we have very favorable interest rates on the HELOCs out here. So they usually their rates or starter rates. So a lot of times banks were doing like promotion periods where you could do like a HELOC for 1 year. Maybe at the time the interest rate was 1% or 1.99%. You could get a 2 year teaser rate, but basically that interest rate for the HELOC was actually lower than a lot of people's mortgage rates. So people were converting their mortgage into a line of credit. And so there is two ways to do it. Some people kept their mortgage there if they had enough built-in equity and just took out like a HELOC, a second HELOC, and used that as money kind of either invest or they were using that and to focus because it basically a lot of money is flowing into this account, and because it's a simple interest and not amortized like a mortgage, it allows you to keep that daily balance lower typically. So all your bills are supposed to funnel through this account, or all your streams, like your paychecks. So it keeps that balance as low as possible. And then you pay all your bills out through this account. So it fluctuates quite a bit. But because your rate is based daily, not amortized, your payments are actually going to be lower typically. So if you keep making these same payments, you should be able to pay down that mortgage a lot quicker. And
Hmm.
that's what a lot of people were doing because this interest. And then, a lot of people might ask, oh yeah, but you might only have 1 year on this teaser rate or 2 years on this promotion rate. But every bank was pretty much offering their own teaser rate. So you would basically just do it with one bank. Then
Yeah.
when that promotion is coming up, you would take it to the next bank. And yeah, it's a little bit of work, but it's not like a mortgage where you need all these documents. So it was kind of a simple process, but it's just the hassle, I guess, in some ways that you'd have to keep switching from bank to bank, setting up your payments to, deposit your payments through this account and whatnot. So it is a little bit of work, but it was worth it. People were paying off their mortgages in 7 years or so. So a lot of people had a lot of this equity. But like I said, you start realizing, shoot, I still got property taxes to pay. I've just paid off home, but I've been, and that's kind of why too, like I said, it really started focusing me on getting cash flow and generating cash flow.
Mhm. Yeah, no, that's great. I think the whole strategy can be really useful for somebody, whether it's their primary or, whether it's an investment property, just trying to pay down that debt. Because I, I don't know about you, Mark, but I've realized for me, it's like, cash flow is great, if you're making, 100, 200 bucks on a property, but it's like you're not making your money until you have mortgage left, no payment. So, for me, at least right now, the whole name of the game is how quickly can I get properties paid down to zero, unlocking
Yeah.
that cash flow.
Yeah, I
So,
think these past few years or recently, a lot of people are kind of reevaluating their portfolio or maybe looking at their strategies are a little different, or even wanting to take some chips off the table or lessen the risk. At one point, everyone was just trying to acquire, acquire, acquire. When I get debt, it doesn't matter. I'm just going to get all these properties, it doesn't matter if it's cash flowing, $100 as long as I got this property and there's equity. But then now, like you're saying, right, insurance rates, property taxes, all these things are going up. And you're like, man, I'm losing money on all these properties. It's harder to cash flow. Or I got to deal with tenants. And I think a lot of people are starting to reevaluate what their strategy is or what their risk profile is.
yeah, absolutely. How do you feel like you're handling that yourself for your current portfolio?
Yeah, so I think I definitely agree with you. At some point, I would love to have a few paid off properties. I do have some things in Hawaii where I have a lot of built-in equity. So from that standpoint, I feel that's kind of like my ace in the hole, where I'm a little bit maybe riskier in some areas because I know I have this equity built up in Hawaii, which are very stable. Um, but I think that's the trajectory that most people go through. Like you probably did it when you first started, and same thing for me. It was like, man, if I get 100 properties or if I get 200 properties and they all cash flow this and I'm gonna making all this money. And I think that's how everyone jumps into it. They look at it that way, like, hey, all I need is this many doors and I have a property manager. I don't have to deal with the tenants and I'm making all this cash flow. But as you start going through it, and for I don't want to create another job. I'm trying to get away so I can enjoy my time and like how I was just in North Carolina, South Carolina, that area, for like 3 weeks, right? Just, hanging out, driving around, checking out properties. I was with my son, seeing family. But that's kind of the goal, right? Where you can kind of go on these trips or spend 3 weeks away from things. And yeah, you might have to do some work on your phone or whatnot, respond to some messages. But for the most part, you can just take some time off and you're generating cash flow with the least amount of headaches. And I think at some point, you got to make that decision, right? And I think for me, that's where I'm at, where it's kind of like that vision or goal when I first started of getting this huge portfolio that is not for me. And I am a little bit older. I know you're a lot younger than me, so I think you might still have that fire in you. It also seems like you've also kind of looked at it where at some point I'm going to start limiting risk or taking some chips off the table. And I think it's just a phase that most people go through.
I agree with you. I think it certainly is a phase, and whether that's seasons of life or that's just, seasons of, tenureship, so to speak, with your portfolios. I mean, Mark, I think you bought your first one in 2019. I bought my first one in 21. So it's coming up on about actually next month it's 4 years. And I'm like, okay, I've owned properties for 4 years. Like I've been acquiring every year. It's like at what point is enough enough? Not from the, aspect of I'm just raking in so much money, but it's like, do I need to start lessening risk, trying to focus on debt pay down versus just acquiring? So I think those are all kind of common, you know, trends that all of us as investors have to go through, in our own portfolios.
Yeah, absolutely. I don't know. I mean, I know you're interviewing me, but this is kind of a question for you. But I don't know if you saw. I know we both follow Michael Zuber, but he had an interview with like Brian Adamson, and Brian Adamson was talking about selling off his portfolio basically to almost like kind of get a debt-free type of portfolio of properties or properties maybe in higher area neighborhoods or better neighborhoods and just have it debt-free certain amount of cash flow, but he also realized where he can make just as much money on some other things that he's doing, like as a business or some passion stuff that he's doing. So it's kind of like I'm going to take all this risk off the table, have just whatever cash flow I'm generating from this low amount of risk or debt on these properties. And now I can just focus on this business or this thing that's generating me money, which I enjoy doing. And I think I see that in you actually. Like you're saying, you're trying to maybe pay down these properties, lower your risk. But I see that like in the school community and whatnot, you enjoy that creative side. You enjoy finding deals. You enjoy working with people. So now, like, once you get this portfolio that is low risk or in a sense, and you just get generating cash, so now you're probably just gonna have fun and be like, I'm just gonna go out there and kind of do this business side of things. And I think I see in what your end game is. I don't know, maybe I'm wrong, but that's kind of what I see for you. Just meeting you in person and seeing you in the school community.
Yeah, I honestly I've not really thought through it too much other than the fact that, kind of like you alluded to, I want to get to a point where I have enough properties paid off. Like right now we have 13 doors across, I think 7 properties, a 4 unit, two or three duplexes, and the rest are single family or townhomes. So I think I'm realizing that there are certainly some assets in better locations. Cash flow is better on certain properties, but I'm kind of making a 7-ish year bet that I think that properties will probably double, particularly for single families in that time frame, because I'm in a point market similar to you, Mark, up in Pittsburgh. My properties are either in Ohio, North Carolina, or South Carolina, all of which they're below the median, or the national median price point. So I'm like, okay, if I have $100,000 house, can I, do some work, make it look really nice, and in 5, 7 years it's worth double that, 200,000. Maybe it's not going up to 350, which is the median price point, but I, I think it can get close. So I think really the question for me is going to be to figure out once I get there in 5 to 7 years, what do I do with my new equity? Do I start selling and paying off some? Do I sell and 1031 reinvest? So it'll certainly be a bridge I have to cross and try to figure out what I want to do. But no, I definitely do enjoy the business of it as well.
Yeah.
So well, let me go back to your portfolio, because I
Mhm.
know your stuff is in Pittsburgh, but you're obviously not in Pittsburgh. Do you have a property manager that manages everything for you so you can, just enjoy your life in Hawaii, or what does that look like?
Yeah, so I mean, I went the traditional property manager route initially. It's worked out well. I think a lot of people do have nightmare stories about dealing with property management companies. So fortunately, like I mentioned, my friend who was investing in Pittsburgh first, he had a property manager, or he still does, and we still use that same property manager. So maybe we lucked out. Maybe we didn't go through the headaches that a lot of other people have seems like they've go through, going through managers. The one issue or maybe concern I did have was I know that my property manager also does things on the side as far as, he's trying to also build his portfolio, right? So he does fix and flips that. So my concern was always that, oh, maybe he starts just focusing on that and he, starts his own business or he does something and he focuses on that aspect his business in a sense. So it kind of was like, man, I don't want to be put in that position where one day he says, you know what, I'm gonna hand your properties off to someone else because I'm gonna start my own business. Or I'm gonna go more into fix and flips, or even his focus is maybe not on my properties because he's doing fix and flips. So that was always my concern. So I kind of went down the self-managed route for property. So there's still a handful that are under him, under that property manager. But I also, talked to him. I said, hey, these are my concerns, but I also kind of want to put systems in place so if something ever did happen, I could always just take over my portfolio and have these systems to where I can manage it on my own. So I'm kind of I call it a hybrid style, I guess. So I do use Hemlane platform, do like tenant communication, collect rent. You can always change the features. You can do leasing through it, have maintenance requests. And that was initially what I was initially on when I was doing this thing. So I was on the highest tier with Hemlane, using them for maintenance requests, sending out vendors and whatnot. But then I also kind of realized too, I think as great as Hemlane is, they started getting a little more expensive, just like anything, right? Things costs go up. And I think if your rent is not at a certain point, it's not as beneficial to use Hemlane's full tier package. You're not going to save too much money than going just a traditional property manager route. So like I said, I am kind of doing like a hybrid style where I am using Hemlane to collect rent and communicate with the tenants. but I've also built a lot of relationships in the Pittsburgh market. So I do have another brokerage or management company that kind of handles the maintenance requests. So I receive the maintenance request, I with the tenants, and when there's an issue, I submit it to either a handyman that I know, or I submit it to this property management company that I know. Can you, go take a look at this request? Or if there's an emergency, I do have the tenants do have access to that company's 24/7 hotline. So
Mm.
I do all the communication, the leasing and whatnot. But if there is any maintenance stuff, I just submit it to this company. And what I have realized is end of the day though, I probably would have just a property manager when it comes down to it. Because even though it's fairly hands off, self-managing or hybrid managing, for some reason, it's always when you're trying to do something else, you'll get some sort of notification, and you got to kind of deal with it. So at the
Yeah.
end of the day, I'm probably going to go full with a property management company, and that's kind of the vision. And hopefully, I'm making enough money to where it's like paying this fee or whatnot is not a big deal to me, right? So I think that's the goal. Yeah.
Yeah. No, that's great. I mean, I think there's some people that do it so many different ways. I'm similar, but a little bit to you. Um, we self-manage all of the properties that are local to me in South Carolina. So, we're able to do that as agents on my side here because we have ownership interest. So it works out for us. But then for stuff that's not local, I have third-party property managers that are essentially full service. I've also built out tools and resources, everything from leasing pipeline to, full contact. I've got the full suite of software. We use RentReady on our side. It's just a little bit cheaper and we need to, but I can roll that platform out to any place in the US. And if I decide, hey, I really hate my manager today and I want to
Yeah.
fire him, I could always do that. So I like that approach, doing it like you're doing it or doing it like I'm doing it. It's building the tools and resources so that you still have control. You know what's happening with your properties. You're ready to go handle, any sort of issues, requests, and it's not, sucking resources and time away from you.
Yeah, absolutely. I think it also, you're saying, I think a better investor too, because like you're saying, you're putting systems in place. It also helps you deal with, if you ever do deal with a property manager. Like let's say you do go, you decide to change your plan, and at a certain point, you're like, I'm just going to have a property manager take over. You have some experience doing this. You kind of have a way to communicate with that property manager or know your expectations because you've already done it. But I think it also, like you're saying, I don't ever want to be put in that position where all of a sudden my property, whether you have to fire him, whether they decide to, maybe they're moving out of state or, they're taking another job. But I don't want to ever want to be put in that position to now I have to scramble and figure out how to do this on the fly. And I think that's one way to lose all the money quickly.
No, I absolutely. Mark, what is one resource that has been instrumental in your growth as an investor, whether that's like a book, a course, what is one thing that's been really helpful for you?
I think one resource for me is kind of community. I think as far as whether it's being in like Michael Zuber's one rental at a time kind of community. He does have a kind of his branches out there where like you already touched on Coach Carson, Dion Financial Talk, Millennial Mike, Lumberjack Landlord. I think what it is being in this community of different investors where everyone has different styles, different strategies, but you see that there's not one way to do something. But I think it's also like you're saying, you talk about resources, but being in this community allows you to find all these different resources. So like you just mentioned, Rent Ready, I believe, right? So for me now, I may look into that because you talked about it, right? So we have this relationship now. I mentioned Hemlane. Now there's going to be other people that might, hey, listen, I'm going to look into what Hemlane is. So I think the resources is more just based on the community that you're in. And like I talked about, like Michael Zuber's formed this school community and you see so many people in there doing different things, like Jared, who does pad split rent by the room, and he's killing it out there. But there's so much people that want to learn that strategy, right? And they're trying to figure out what resources he's using. So I think for me, it's more the community that you're in that just allows you all these different resources that you can access.
Yeah. Well, I think, community and, networking with other people, is really the name of the game. I had a mentor tell me getting started, he said, hey, business is relationships. It's all about who you know and who knows you and how you can help other people and they can be a help to you. So I think that's great advice to, get in some sort of community, just other people around you.
Absolutely. I think, and like I said, that's how we connected. We met up in North Carolina. You drove up to North Carolina. I went up to Charlotte, Winston-Salem after, and I met up with Val, Andy, Divin and Dave from kind of the original One Rental at a Time community. But it's like you said, it's just meeting other people that are doing the same thing. And I think maybe, I don't know how long has maybe, all that been around, but if you probably look back maybe 15, 20 years ago, you were kind of just limited to the people that were in your, 10-mile radius, maybe, right? Again, that's kind of limited maybe your focus or your vision or your resources. But now, I can hop, hey, Hunter, I have this question. Can we jump on a Zoom call? Can we connect or, whatnot? And I think that's just allowing a lot more people to get out of their comfort zone. And maybe people think it's weird you're talking to people over Zoom calls. But to me, I think that's just that's just the future, right? I mean, to me, I feel like this is in, right? I don't know.
Yeah.
That's the way I look at it. Yeah.
Yeah, no, I agree. It's it's breaking down this and allowing further, relationships and development growth. Well, Mark, hey, appreciate taking some time out of your day to talk with us. If people want to get a hold of you or just connect with you more, where can they find you?
Yeah, so like you mentioned earlier, my handle is Financial Firefighter. I'm kind of all over social media, Instagram, primarily YouTube, probably YouTube and X. But yeah, I have my own YouTube channel, so go check it out, Financial Firefighter. Hunter's joined me on a few lives. So I've been focusing more on the live streams. I have a lot more fun on the live streams. So I try to get different guests on weekly. So I probably do about 2 to 3 live streams a week, and we'll get you back on, talk about your creative finance stuff you're working on, your school and things like that, and your kind of what you're working on. Like I said, we'll get the questions out there in the lives, we'll answer them as they come through. But I think the lives are a lot of fun.
I agree. Yeah, you can certainly, really dive into topics and, still interact with people who might even be watching it, which, we're recording this now and somebody's going to watch this, days or weeks or months after we've even recorded it. So it really just allows for more interaction and connection.
Yeah, man,
So,
it's a lot of fun. I hope you have fun doing it, and we'll get you back on too, man.
oh yeah. Hey, I'm looking forward to it. Let's do it. Sounds great. Well, everyone, thanks so much for tuning in today. Again, connect with Mark, connect with him on X and YouTube, and we'll talk to you soon.
All right, everyone.